Schedule C, insurance expense. Come in, relax with income tax 2020. Schedule C, insurance expense. When thinking about the Schedule C with regards to our income tax equation, we are in essence talking about the top line, that being the income line, noting that we do have a separate schedule, that being the Schedule C, which has income and expenses on it. Expenses basically being deductions to get to the net income or net income for the Schedule C in essence, which will then rolls into the top line, basically the gross income line of our income tax formula, where we then apply out the above the line and below the line deductions here to get to the taxable income. So we're thinking about the Schedule C at this point. We're thinking about the deductions related to insurance. Now, in general, just from a logistical standpoint or data input standpoint, normally the insurance would be deductible if it's going to be ordinary and necessary. So if you're talking about something like a liability insurance, you would think that would be a fairly straightforward deductible component. However, we also have that health insurance, which we talked more about in the above the line deduction category of the course, because that one is a little bit more confusing in terms of how to deduct it and possibly where to deduct it. We might get a deduction for the health insurance for the business owner, for example, but it may not go on the Schedule C. It might go on then the Schedule 1 as basically an above the line deduction here. So for that one, you could take a look at it. We'll go over it a little bit here, and you might want to take a look at the above the line deduction presentation we did prior that gets into that deduction as well. So if we think about the Schedule C, remember the Schedule C has many different impacts on the tax return. This is the first page of the 1040 where we got the Schedule C income, the sole proprietorship rolling into line 8 here from the Schedule 1 Part 1. We also have the above the line deduction related to the self-employment tax, which is half of it is going to be deductible here. And that we also have the standard deduction, which is not dependent on the Schedule C, and we could have the qualified business income deduction. So a lot of different impacts with the Schedule C. Here's an example of the Schedule C where we have the income and expenses down below. We're now thinking about the insurance line item. So you'll see down here on line 15, we have insurance, and it says here other than health. So remember, when we're thinking about basically health insurance for the sole proprietor, you may be able to deduct it, but usually it's not going to be here on the Schedule C. It's going to possibly be in another section. It's going to be in Schedule 1. It's going to be basically an above the line deduction. So when you're thinking insurance here, the first insurance you'll probably be thinking about is like liability insurance and or insurance, say, on vehicles that are going to be used within the business. And just note, when you're thinking about the health insurance, you might think, well, why would they pull that away from this component here in the expenses side and then deduct it somewhere else, like on Schedule 1? Well, one reason that could be the case is because that means that it's not going to be deductible for the Social Security and Medicare, meaning the self-employment tax, but it will be deductible for federal income tax purposes. So in other words, if you want something to be deductible for federal income tax purposes only, but not for the Social Security and Medicare, then typically the easy way to do that is to take it off the Schedule C and then move it somewhere else. So the Schedule C will still be applying the tax for Social Security and Medicare, and then you could take the deduction as an above the line deduction, and that'll make it go down for the federal income tax. So from a logistical standpoint, when you're just entering the data into the system, then this should be something provided by you. And when you get the income statement, when you're entering the tax return, hopefully then this has been broken out already, and it should be fairly straightforward if done so to do the data input related to the insurance. You just want to be aware of the types of insurance that are just business related insurance that would go here, and break out possibly like the health insurance where it should go properly as well. Now note that although we have the 2020 tax forms for the Schedule C, we're pulling some of this information from, say, the tax guide for small businesses, and the 2020 version is not out yet. We're looking at 2019 primarily, and then making adjustments where we see applicable. However, note that the primary information is coming from 2019. If you want to look into more detail on any specific topic, you can look this up yourself. The 2020 should be up shortly, and it'll be on the IRS website at irs.gov, irs.gov. So insurance. You generally can deduct premiums you pay for the following kinds of insurance related to your business. So we could have fire, theft, flood, or similar insurance. Now, again, obviously, these items, if they're applied to the business directly, then you would think they would fall under expenses. They would be ordinary and necessary, the components for a business. As far as deducting them in terms of when you make the deduction, notice you could have some difference in terms of prepaying the insurance. So you could have an issue in terms of when did you make the payment, how long was the insurance covered. But just realize that the deductibility for things like fire, theft, flood, and similar insurance you would think would be ordinary and necessary, therefore deductible for a business purpose if applied to the business. So credit insurance, insurance that covers losses from business bad debts. So if you have insurance related to the bad debt, basically the accounts receivable or those that you may not be able to collect on, then you generally be able to deduct that, and that would make sense as an ordinary and necessary expense of the business. Group hospitalization and medical insurance for employees, including long-term care insurance. So if you're providing the insurance as basically benefits or part of the benefits to the employees, then you have that benefit program to the employees and possibly the deductibility there. Again, that's a little bit different than the insurance possibly provided by the employer for medical insurance, which may need to be deducted in some other location. Liability insurance, that's the obvious one, or most obvious in my opinion. Obviously, the liability insurance, ordinary necessary type of expense for the business because it's for the business. Therefore, you'd think you would deduct that one. So we have the malpractice insurance that covers your personal liability for professional negligence resulting in injury, damage, or to patients or clients. So again, that would be malpractice insurance. That would make sense that you would need that for the business, ordinary, necessary, therefore deductible. Workers' compensation insurance set by state law that covers any claims for bodily injury or job-related diseases suffered by employees in your business regardless of fault. So workers' compensation, often required depending on the state, is also, ordinary, necessary, therefore deductible. Contributions to a state unemployment insurance fund are deductible as taxes if they are considered taxes under state law. So typically, you've got the SUTA tax, state unemployment tax, and that'll typically be deductible. And most states have it because the Fed kind of maneuvered them to have it by doing a kind of sneaky move by putting the federal unemployment tax tied to the state unemployment tax. So typically, you will have that state unemployment insurance, and we'll be calculating that. That'll be an ordinary and necessary expense. Overhead insurance that pays the business overhead expenses you have during the long periods of disability caused by your injury or sickness. Car and other vehicle insurance that covers the vehicles used in your business for liability, damages, and other losses. If you operate a vehicle partially for personal use, deduct only the part of the premium that applies to the business use of the vehicle. If you use the standard mileage rate to figure your car expenses, you cannot deduct any car insurance premiums. So the car is going to be one of those confusing ones because obviously, again, the car for a sole proprietorship, you might have a car that's for personal and business use. Now, if it's fully for business use, then it's fairly straightforward, and you could take the deduction. And if you're taking the actual expenses rather than the mileage method, then you would basically include the insurance because it's the insurance on a vehicle you're using in the business and therefore ordinary and necessary. If you use it partially for business and not or using the mileage method, then the mileage method in essence is kind of combining in the cost of insurance and the calculation of the mileage method. So you may not be able to get the insurance because you would need that in the direct method. We talked more about that with the car and truck deduction. So you can take a look at that presentation for more information regarding insurance on the auto. So life insurance covering your employees if you are not directly or indirectly the beneficiary under the contract. So the life insurance, if you're paying life insurance for the employees, and typically, obviously, the beneficiary would typically be, their spouse or, something like that. If you, the company, and the sole proprietorship is the beneficiary, then it would be different. So if you're paying normal life insurance and it's like a benefit to the employees and you're not the beneficiary, then it could be deductible. Business interruption insurance that pays for lost profits if your business is shut down due to fire or other cause, non-deductible premiums. Self-insurance reserve funds. You can not deduct amounts credited to a reserve set up for self-insurance. So basically, if you don't trust the insurance or whatever, and you want to set up like your own fund, which you're basically designating as insurance, then you can't deduct the amount that you put into basically your own fund, really, for insurance in essence. This applies even if you cannot get business insurance coverage for certain business risks. However, your actual losses may be deductible. For more information, see publication 547, Casualty, Disaster, and Theft. Loss of earnings. You cannot deduct premiums for a policy that pays for lost earnings due to sickness or disability. However, you can see item 8 in the previous list. Certain life insurance and annuities. So for contracts issued before June 9, 2017, you cannot deduct the premiums on a life insurance policy covering you, an employee, or any person with a financial interest in your business if you are directly or indirectly a beneficiary of the policy. So this is the inverse of that life insurance we talked about before. If you are the beneficiary as the business, as opposed to like their spouse being the beneficiary of a life insurance, then that's going to change the deductibility of it. So you can include among possible beneficiaries of the policy if the policy owner is obligated to repay a loan from you using the proceeds of the policy. A person has a financial interest in your business if the person is an owner or part owner of the business or has lent money to the business. So for contracts issued after June 8th, 1997, you generally cannot deduct the premiums of any life insurance policy, endowment contract, or annuity contract if you are directly or indirectly a beneficiary. The disallowance applies without regard to whom the policy covers. So insurance to secure a loan. If you take out a policy on your life or on the life of another person with a financial interest in your business to get or protect a business loan, you cannot deduct the premiums as a business expense, nor can you deduct the premiums as interest on business loans or as an expense of financing loans. In the event of death, the proceeds of the policy are not taxed as income, even if they are used to liquidate the debt. So now we have the self-employed health insurance deduction. So this is the one that gets a little bit confusing. So we have the sole proprietorship now, and we have kind of self-employment insurance or self-employed health insurance. So you may be able to deduct the amount you paid for medical and dental insurance and qualified long-term care insurance for you and your family. Note that we talked about this in a little bit more detail in the above-the-line deductions in a prior presentation, so you might want to go back up to those, the adjustments to income presentations for the deduction for self-employed health insurance for more information there. But how to figure the deduction, generally you can use the worksheet in the instructions for Form 1040. So a place to start your research then would go to the 1040 form. You can go to the IRS website, irs.gov, look at Form 1040 instructions, and then you'll find information related to the self-employed health insurance. That might be the place to start. However, if any of the following apply, you must use the worksheet in Chapter 6 of Publication 535. So these things that we're going to take a look at are going to complicate matters a little bit, so that you're going to have to move from the Form 1040 instructions possibly to Publication 535, which you can also find on the IRS website at irs.gov, irs.gov. So you have more than one source of income subject to self-employment tax. So if you have like 2 Schedule Cs or something like that, that can complicate things. You file Form 2555 or Form 255EZ relating to foreign earned income. So if you have foreign earned income, you are using amounts paid for qualified long-term care insurance to figure the deduction. So then you can use Publication 974 instead of the worksheet in the instructions for Form 1040 if the insurance plan established. So again, your default is to have the 1040 instructions, probably the place to start, and then see if any of these complications apply to move from there. Or considered to be established under the business was obtained through the health insurance marketplace, and you are claiming the premium tax credits. So if that's going to be involved, that could have some more complications there. We'll take a look at this in a practice problem in the following presentation, and you may also want to look at the adjustments to income in prior presentations that we looked at in a prior section.